So when I think about the last 40 years and what people were used to when they think about what they see in a business cycle where the Fed comes in, they start raising rates, everything they suck the demand out of the economy, it resets itself, and then they do it all over again. And then more recently, you see that with QE, that's kind of the solution. But right now, do you see the current setup potentially being different than what I think everybody is expecting to see by them aggressively tightening? And do you see that bringing inflation back down to levels that people used to see, or is there something different here? Kind of quantify what you think that could be different this time.
So I think it comes down to like time frame expectations. And so if you look over the past 40 years, if anyone has seen like an interest rate chart, for example, you start out at a very high level after the 70s, and you have 40 years of lower lows and lower highs of interest rates. And that's allowed for higher and higher asset prices, whether it's real estate, whether it's equities, just higher and higher. And my thesis for the past couple of years is that we are entering a structural change where once interest rates get all the way to zero or negative in some countries, that there's really not much further to go, and debt is already super high. And so we're going to start entering this regime of sideways to higher interest rates, which means generally lower average valuations and generally just a lot more like turbulence in macro markets. It's not that constant 40-year bull market. It's not that thing of just things always go up. When we look at, say, for example, the U.S. stock market, stocks go structurally up over and over again, but there are like these long periods of time, whether it's, say, from the year 2000 all the way to 2011 by the time it surpassed it in inflation-adjusted terms, or you go back to the 70s, you basically had this choppy sideways stock market for over a decade, or you go back, of course, to the 1930s, and it took a very long time for the stock market to recover. And I think, especially in inflation-adjusted terms, I kind of think we're in that environment, and I think we have to think differently about the market regime we're in now compared to any time in the past 40 years. I think we're going to be in a more constrained world, less globalization, and a more difficult energy situation.
Yeah, so if they step in, let's say that something starts breaking in the credit markets, things start seizing up, and they have to step in, and we're still at these very high inflation levels, way higher than I think anybody ever imagined a year ago where we'd be right now. And so those things happen, and then they respond with what I would expect to be, and I'm curious what your thoughts are, an enormous amount of stimulus in order to keep that together. What does that look like? Does it look anything like what we've seen in the past where they're just flooding the market with liquidity, or is it much more surgical? Can they do it in a more surgical way? What are some of your thoughts in that area?
So obviously it's hard to see the future, and it depends on individual human choices, which is what makes it hard to predict. But I think the base case to at least be aware of, or to look for and expect, is a more stagflationary type of environment. We could very well be in an environment, like right now, for example, if anyone's seen the latest inflation print, the official inflation rate is at a very high level, but it is falling from its year-over-year peaks. And you see things like used car prices and house prices, they're kind of coming down, but we still have very sticky energy prices. And I think that's where a large part of the problem can be, right? So you can get certain things under control, certain supply chain issues, but we still have a structural underinvestment in energy. And when we look back over the past year, for example, we've had the Fed raise rates almost as fast as they've ever raised it. They've kind of rivaled, even though they haven't rivaled Volcker, the 1980s, in terms of how high interest rates got, they have rivaled Volcker in terms of how much you raise in a single year. So they've already been super hawkish. They've already drawn down their strategic petroleum reserve, which is trying to fight energy inflation. And I think a lot of that is now behind us. They're still going to raise rates to some percent more, but they've already drawn down the oil reserve so much. I think we're going to be in an environment of more problematic energy scarcity, higher energy prices, even if some other prices settle down for a period of time due to demand destruction or due to supply chain normalization. And I think that's going to be an ongoing problem. And I think that the type of stimulus that they do is going to be a little bit more surgical. It could be energy stimulus. It could be things like that. It could be even the combination of higher rates combined with some sort of liquidity program, for example, on the sovereign bond market. And I think that's not going to be the type of all-out environment where just you buy every risk asset and it goes up. I think it's going to be a much more selective environment. You have to own quality rather than just own everything.
So something that pops out of all this is you have this dollar strength that is insanely aggressive compared to previous periods against all these other fiat currencies. Give people an idea, like your thoughts on 200, countries that have maybe really weak currencies relative to the dollar, and then all their dollar-denominated debt. Like, what's it like for these countries, for the people in these countries, and how does that tie into Bitcoin?
Yeah, I was actually going to say that's actually a good point to tie it into Bitcoin, because when we think of Bitcoin, we often think of it in a developed market perspective. We think of it as a United States person. We think of it as a European, for example. And people are like, why do you need Bitcoin? What is Bitcoin useful for? Whereas when you go to Argentina or Nigeria or dozens of other countries in the world, it's far more obvious why people need Bitcoin and why they might be interested in it, and why they might be interested in things like stable coins or things like ways to get US dollars, basically various types of harder money than whatever their local money is. And when the dollar gets super strong like it is now, the Fed is increasing interest rates, they're doing quantitative tightening, and they're trying to rein in inflation. And the problem is that there are so many countries in the world that buy commodities in dollars, right? So they're having a much harder time buying commodities. And then a lot of them have dollar financing. They have dollar-denominated debts from European lenders, from American lenders, from Japanese lenders, from Chinese lenders. These just dozens and dozens of countries in the world get squeezed when we do this. And imagine you're a country and basically another country can dictate your monetary policy for you. That's kind of the world we live in. And what Bitcoin comes around and does and says, here's an alternative. It's new, it's volatile, it's poorly understood, but it doesn't change its monetary policy based on the decision of a handful of people in a room. The Fed is basically a council of elders that sits around and determines the price of money, right? And Bitcoin doesn't have that. It's an open network. And so right now, kind of for lack of a better alternative, all the countries in the world, and especially the periphery countries, are tied into the dollar system. And so they're at the whims of the Fed. They can loosen dollars, and that usually what happens is these countries go out and they take on a lot more dollar-denominated debt, but then that comes back to bite them when the Fed can then arbitrarily at any time increase interest rates, strengthen the dollar, and it's like all of your liabilities are being hardened. And so what Bitcoin comes around and does and says, here's an alternative, and here's something that's worth exploring.